Got markets in record territory, euphoria over those that Oracle forecast. Remember, though, the U.S. labor market showing signs of softening, and a gauge of U.S. wholesale inflation for August actually indicated that prices edged slightly lower. Let's get perspective from Philip Petursson, Chief Investment Strategist at IG Wealth Management. Great to see you, Philip.
Good to be here.
So you think markets don't broadly appear to be in a bubble right now?
Exactly. A bubble would mean that there's this unnecessary euphoria or misplaced euphoria in the marketplace, and I don't think that's it. I think what's happening right now is companies are being rewarded for the strong revenue growth and the strong earnings that we've been seeing, and we're starting to see a broadening out of this. It's not just concentrated around the Mag 7. I think Oracle's results are a good example of that you're starting to see participation elsewhere in the S&P 500. But we can relate that to Canada as well, and we've been getting some good results out of Canadian companies, so it's not just like an AI story. It's almost like an everything story.
Valuations, you reckon, tend to be not a good predictor of short-term returns from the market. I mean, we often hear the market's expensive right now.
Right.
What's the takeaway, though, there?
I would argue it is, right? If you look at the U.S., it's trading at the top end of its 20-year range on a PE basis. If you look at the TSX, it's trading near the top end of its 20-year range. Outside of North America, valuations are much more reasonable, but valuation alone is a terrible reason to sell out of the market. It tells you nothing about short-term performance. What it tells you is that, yes, stocks are fully valued, but you have to understand why. Why are they fully valued today? Is it on false earnings? Is it on like just buy anything and hope for the best? No, it's on good earnings. Again, Q2, we came through 11% earnings growth year over year for the S&P 500, 90% of companies beating. That's good news. So that justifies the valuation where we are. And then I would add to that, we have the Fed that's about to reignite a easing cycle. And that's good for valuation as well. So lower interest rates, that supports higher valuation, stronger earnings, that supports higher valuation. I'm not concerned that we're in a bubble or too expensive like we were back in 2021, or if you want to really go back, you can say 2000. That's when the market was in euphoria and massively overvalued.
Maybe let's put up a 10-year chart for the NASDAQ 100 as a proxy for tech stocks, because, of course, they did have that big run-up in 2021, and then there was a couple of years of pain.
There was, but the pain was justified. Again, in 2021, remember that this was the era of meme stocks. You had the Reddit boards, Wall Street Bets, and so on, and stocks were moving higher for false reasons. Again, that's not the case. Today is very, very different. Valuation is better than where we were in 2021. And remember, in 2021, inflation was going higher, rates were going higher. Today, rates are going lower, inflation's going lower. So I'm comfortable with where we are.
For a long time, Uber, the critics said, well, it's not going to be profitable. It's just funded by VC money. Uber, of course, now does make money. But it's interesting, you say that investments in AI are being funded out of actual profits and not just venture capital cash.
Exactly. And I think that's the key difference. We're seeing hundreds of billions of dollars being invested in AI across, again, the Mag 7, but numerous other companies. Every company is going to be using AI to some extent. And the investment in AI is coming out of earnings, profits. It's not being funded by VCs for some hope that that idea will stick. It's actually being developed by companies that are on solid footing and have the money and the revenue and the cash flow to finance this R&D.
Maybe we could put up a 5-year or 10-year chart for the TSX Banks Index. Is there any risk that Canadian banks are getting ahead of themselves? Because we do have an economy that's softening.
Absolutely. When you look at the most recent GDP number, that's a contraction now. You balance it off with first quarter that was stronger than expected. It's not terrible for the first half of the year, but it's not great either. The banks, they're being faced with perhaps slower loan growth. Loan loss provisioning has been increasing. We're seeing higher delinquencies or delays on payments. But in general, the bank's profitability is fine. Valuation is a little bit higher, but that's consistent with where the rest of the market is. In an environment where we expect a steepening of the yield curve, that's good for net interest margins. That's good for the banks overall.
Maybe we can put up Group Dynamite without asking you to comment on the stock. It was an IPO less than a year ago. It drifted at first. It's shooting up today. Are you disappointed about the lack of IPOs in Toronto?
Well, you can look at it two ways. One, you can say that maybe we haven't embraced the capital markets to the extent that we should. On the other hand, you can say, well, we haven't been in exactly a favorable market for IPOs, whether it's Canada or the United States. There hasn't been a lot of M&A activity, but now it's starting to pick up. Now we're starting to see names come to market. And so I wouldn't say that there's nothing to look forward to. I think, if anything, there's more to look forward to. And yes, perhaps it's been a lot slower over the past couple of years, but justifiably so.
And what about the unreliables, the pipelines and utilities in Toronto? Are you seeing value there still?
Well, that's an area that I would say, if you're expecting lower interest rates, yes, you should see push up in valuation. But I think there are better areas in the market, to be honest with you. The defensives, I think we're starting to see a rotation away from the defensives and into still the pro-growth, pro-cyclical stocks and sectors that are available to investors.
Thanks very much indeed for joining us, Philip.
Pleasure.
Philip Petursson, Chief Investment Strategist at IG Wealth Management.